how do self-employment taxes work and how can you avoid them? Hey, it's Sherman the CPA, and today I want to fully explain how taxes work for self-employed individuals. I work with a lot of business owners on a daily basis, and many people I talk to don't fully understand their responsibilities as a self-employed taxpayer. And this is very dangerous because if you do not understand how taxes apply to you as a business owner, then you cannot even begin to think about the tax strategies you could use to reduce your tax bill and put more money back into your pocket. So my goal today is to give you the simplest, most easiest to understand explanation to help you navigate taxes as a business owner. And I will also give you some ways to reduce the amount of taxes you will pay as we go along here. So if that sounds good to you, go ahead and like this video for me below and make sure you subscribe to this channel for more videos just like this one. All right, so the first big tax is self-employment tax. This is a tax that surprises most business owners I talk to, so let's break this tax all the way down. Self-employment tax is just a simplified phrase for Medicare and Social Security taxes for business owners. In any employer-employee relationship, both the employer and the employee must equally contribute to Medicare and Social Security taxes. Now, normally, each party contributes 7.65% of the employee's gross income towards these types of taxes. However, since you are self-employed, you are now responsible for paying both the employer's and the employee's portion of this tax, which equals a total of 15.3%. Now, once your income exceeds about $150,000, this tax does start to phase out. But in general, 15.3% of all of your business income will be paid towards this tax. Now, when I say business income, I am referring to your income after taking all deductions available to you. Remember, one of your greatest tax advantages as an entrepreneur is the ability to deduct expenses that most people cannot. If you want to learn how to do this step by step, then make sure you join my Tax Savers Club at mycpacoach.com. But anyway, here is an example of what I mean and how self-employment tax works. So let's say your business made $300,000 in income and has $200,000 in business deductions, which includes things like your home office, your business vehicle, and other ordinary and necessary expenses you incur to turn a profit in your business. Well, in this specific case, your taxable income would be $100,000. And the 15.3% self-employment tax would only apply to the $100,000 in income, not the total revenue you earned in your business. So the first step to limiting the amount of self-employment tax you pay is to maximize your business tax deductions. Now, the second thing you can do to limit your self-employment tax exposure is to simply avoid the tax altogether. So let's go ahead and talk about it. So in general, income from pass-through businesses are subject to self-employment tax. This includes entities like LLCs, partnerships, and unincorporated businesses like sole proprietors. But there is one entity that does not have to pay any self-employment tax whatsoever, and that is a corporation. Now, there are two types of corporations out there: a C corporation and an S corporation. C corporations are generally used by companies who are looking to increase investment capital in their business. So whether it is to take on new investors or aggressively reinvest their profits back into their business. Now, C Corps have completely different tax rules. And even though they don't pay any self-employment tax, they do pay corporate taxes, which can actually end up being a lot more expensive than self-employment tax if you do not know what you're doing here. And because of this, C corporations are generally not recommended for most small business owners. So let's talk about the S corporation, which is also known as the Small Business Corporation. An S corporation is a specific tax election you can make with the IRS as an LLC or C corporations. Now, S corporations have the option to be taxed as a pass-through entity, like a partnership or sole proprietor, or like a C corporation. But let's go ahead and talk about how an S corporation actually saves you money. Well, here's how. S corporations do not have to pay any self-employment tax at all, technically. You can choose to tax your S corporation as a pass-through business and pay absolutely no self-employment tax, even though all other pass-through businesses are required to pay this tax. And trust me, this is not some tax trick or loophole. This is literally written inside of the tax law. The IRS created this tax status specifically for small business owners. Now, of course, there are some rules associated with electing S Corp status that you should be aware of. The most notable rule is the requirement that shareholder employees pay themselves a reasonable salary from the S corporation. So basically, if you do any work for your S corporation, you are required by law to pay yourself a reasonable amount of wages for the work that you are performing in the business. This is how the IRS collects some Medicare and Social Security taxes, because the wages you take from your business as an S Corp is subject to payroll taxes, which actually does include Medicare and Social Security taxes. So although S corporations do not technically pay any self-employment taxes, you will still pay some Social Security and Medicare taxes out of the wages you take from your business. But even with this, electing S Corp status will normally save you more money in Medicare and Social Security taxes than not electing it at all. And here's why. Without an S Corp, you pay self-employment tax on 100% of your business income. But with an S Corp, you can pay self-employment tax on as little as 1/3 of your business income. You can do this by taking a salary from your S corporation that is simply less than your business income. And most CPAs believe that a reasonable salary for an owner that works in an S corp is generally about 30 to 50% of your business income. Now, keep in mind here, this is a general rule, and you should also keep in mind the type of work you're doing in the business, the amount of hours you're working in the business, and also the market rate for comparable services that you are providing to your S corporation. So that's self-employment tax. Now let's quickly talk about the other two taxes, which are federal and state income taxes. So federal and state income tax is actually pretty straightforward. There are federal income tax brackets and state income tax rates that are applied to your personal income. Now, the key thing to know here is that your tax is based on your total income from all income sources, which may include your business if it is not a corporation. So unlike self-employment tax, which is only applied to your business income, your federal and state income tax would apply to 100% of your personal income. For example, let's say you made $75,000 from your business. Well, if that is your only income source, then you would be in the 22% tax bracket. But if you also earn $80,000 from your job and $20,000 in real estate income, then that would actually push you up to the 32% tax bracket. So you first need to be mindful of this, and once you are, you can start to strategize to reduce the amount of income you report on your tax return. For example, you may be able to change your filing status and take advantage of lower tax brackets. You may also be able to change your entity, offset some income with tax losses, or earn tax-friendly income to reduce the amount of income you show for tax purposes. And like I mentioned earlier, do not neglect the #1 tool at your disposal as a business owner, which is taking advantage of tax write-offs to lower your taxable income. This is how self-employed taxes work in general. If you want to learn my complete framework for reducing your taxes as an entrepreneur, then join my Tax Savers Club, where you will get access to my step-by-step course and access to CPAs like myself on a monthly basis. As always, thank you for watching, and I look forward to seeing you in the next episode.